I have made all the mistakes out there when it comes to investing. My goal in this video is to take you through my mishaps and hopefully you won't make the same mistakes. But let's be honest, you probably will, which is okay, this is how we learn. Now, not only will we go through my biggest mistakes, we will also talk about solutions so that you can take these potential mistakes and flip them on their head and possibly profit from them. And well, profit is a good thing. Ladies and gentlemen, my name is Alex Pandrea and welcome back to my finance channel. There are 8 mistakes that we are going to go through in this video, plus a little bonus tip at the end, so let's get started. The first mistake, not understanding what type of investor you are. Are you a trader? Are you a long-term investor? Are you a passive investor? Do you want to be more active in your investing? Do you have a plan for the next 5, 10, 20 years? It is my belief that you should know exactly what category of investor you fit in. Now, this comes with research and learning as much as you can, and also with actually investing and trying things out, right? Nobody says that you need to know what kind of investor you are without actually having gone out and invested. But at some point, you need to put yourself in a category and stick to that based off of what you're most comfortable with. When I was young, I read a book that showed the power of compound interest, and it explains in a very mathematical and proven way how to become wealthy. Then when I was actually starting to put my money into the market, I realized that I did not have the patience for it, at least at the time. I would start to try to trade stocks and think very short term, and in my mind I would always flip-flop between knowing that I should invest long term and trying to make that quick buck. Needless to say, the first 10 years of my investing returned negative gains. It was only after many years of trying to understand what type of investor I am and what style I feel most comfortable with did I make a plan and then stick to that for my investing future. And now at 34 years old, I'm 34, right? Yeah, now 1 year I actually forgot what age I was. So now at 34 years old, I am very comfortable with the type of investor that I am. 80% of my portfolio is set for compound growth over the next 10, 20, who knows how many years. And then I allocate a smaller percentage, maybe 20%, to shorter term risk. And maybe that'll change over time, which is okay, but you need to know this about yourself to get the most out of your investments. Mistake number 2, unrealistic expectations. Now, this is a big one. You see it all the time. I'm going to invest in this company and double my money or triple my money. You always have this talk with yourself. Well, if the stock gets to this amount, I'll 10x my money. Yeah, sure you will. Now look, I hate to break it to you. I'm sure the majority of you don't think this way, but there's a few out there. These unrealistic expectations just don't happen. The S&P 500 returns on average 10% per year, and this is the benchmark, and anything above 10% is considered a very good return on your investment. The biggest hedge funds in the world have trouble beating this 10% return consistently. And when they do, it's not by a lot. An incredibly high return in the stock market would be something like 20% returns, which only a handful of professional investors make. Now, let me be clear, this is on a consistent basis. Just because you doubled your money 1 year doesn't mean that you can consistently do this every year. And I think this is an important thing to keep in mind, and the sooner that you learn to keep your expectations in check, the more successful you will be over the long term. Along these same lines of unrealistic expectations is when I see a trading system out there claim to make 1% per day or 2% per day trading. We need this to stop because this is not only not true, it is dangerous to have these expectations since it could only lead to you trying to go for these returns, and the next thing you know, you lose all your money trading. So let's stick with the facts and let's not invest based off of hopes and dreams and unrealistic expectations. The next mistake, penny stocks. So here's the question for you. Have you ever tried trading penny stocks with the hopes of making millions of dollars? I have.
Penny stocks?
I remember this very clearly. I thought, okay, if I put this much amount into the stock market in this company, and if it goes to this price, I would make this much money. Okay, well, how much do I need it to go up to? $50 per share. I think I'll be okay with that. Hey Alex, the stock is trading at 5 cents now. Now, we might laugh now, but I was very serious about these expectations that I had for the particular company, of which I couldn't even pronounce the name of, let alone know what it did.
Aerotine, yeah. Aerotine,
yeah. Now, this comes down to one thing. education. This happens often with beginners, right? They get a hot stock tip from their mailman, and then the next thing you know, you've invested all your money into a pump and dump. Greed takes over, FOMO takes over, and then this is just a recipe for disaster. I invested into penny stocks back when I was in high school, and if somebody told me at the time that I'm going to lose all my money with these shady companies, I would look at them like they had no idea what they're talking about. And then I proceeded to lose all my money. So I lost about $2,000 at the time, but it was enough for me to learn my lesson about this type of speculation. This could be avoided again just by understanding some very basic investing concepts, which unfortunately, let's be honest, most beginners, especially ones that invest in penny stocks, don't understand. For example, knowing the difference between the price of a stock and the market cap, one of the most basic beginner principles in all of investing. So when they see a cheap stock, they think it is, well, going to the moon, right? Well, this could have all been avoided just by educating yourself just a bit. This leads me to mistake number 4, which is investing off of recommendations or copying other portfolios. Now, we already mentioned the penny stock example, right? Stay away from them, but we all know that now, right? Right? But what about listening to other people on things like forums or YouTube or things like that? There are endless amounts of not financial advice out there, and making investments by what others are saying and what others are investing in is never really a smart thing to do. Unless, of course, you are copying somebody who has, I don't know, insider information, and then maybe possibly we can make some money. But I digress. So why shouldn't we do this? Well, the simple answer is that, one, the majority of the people out there don't know what they are doing. Let's be honest, myself included a lot of the times. All we can do is try our best to grow our investments over time the way that it fits our own personal risk tolerance and investing strategy. My circumstances are different than yours, and therefore the way that I invest might not fit everybody, and then the way somebody else invests might not be a right fit for me and my investment goals. For example, I make money off of my business, which allows me to invest in a different way than somebody else working a 9-to-5 with an average salary who just wants to save and invest for their retirement. Others might be very young and have more of a risk appetite, so they go all in on riskier trades because it doesn't matter if they blow up their portfolio of a few $1,000s like I used to do in high school. The point is that you don't know everybody's individual circumstances, and trying to match an investing methodology to an individual investor is very hard. You need to refer back to mistake number 1 and figure out what investor you are, and then stick to that for your best chance of success. Mistake number 5, not researching the company you are investing in. This took me a while to figure out. Do I really need to research Facebook or Google? Big established companies? I would argue that yes, you do need to research and understand the business that you're investing in, because you want to understand how that business is making money, and therefore you can project out their success into this ever-changing future much better. Where does Google make the majority of their revenue from? Is it ads? Is it software, hardware? Where is their growth coming from? Here is a perfect example. IBM is one of the great established companies of our time. And you might look at IBM and say, well, they make computers and business machines, right? I mean, it's right there in the name, International Business Machine. But when you take a look deeper into where their revenue comes from, you might be surprised that 60% of their revenue comes from consulting services and another 20% from their software. Wow, okay, so this makes you look at the company from a different angle maybe. And this can affect your investment decision. So being able to research a company and understand what you are investing in is something that I think is very important. Remember, we are investing in businesses, and ideally we would like to invest in good businesses, right? So I find it odd that anyone who is serious about building a portfolio of companies and investing would not take the time to look into the businesses when deciding whether or not they should put their hard-earned money into them. This generally would lead to making poor investment decisions, and we don't want that. The next mistake that you will see all the time with not only beginners but more experienced investors as well, and that's to have too much risk in one place. Now look, I am of the opinion that to grow huge amounts of wealth, you should not over-diversify. So if you're investing in 100 different companies in all different sectors possible just to be well diversified, then at that point you might as well just buy the S&P 500 and then keep adding to your position over the lifespan of your life. And then that's how you will grow wealth. Not an insane amount of wealth, but enough to retire comfortably. Now, if you want to make real money, you have to take more risk. But there is calculated risk and then there is stupid risk. Putting all your money into one stock is a stupid risk. It might make you a crazy return, but you know what also will? Going to the roulette table and putting your money on 00 and hoping it hits. If you put all your money into cryptocurrency, again, you are betting, not investing. Now, you have to personally weigh the risk reward in these scenarios, but more often than not, having too much of your investments in one place is asking for trouble at some point. It also creates this mentality that would go against proven wealth building strategies. So that alone will put you already at a disadvantage. So as that old saying goes, don't take all the eggs and put them in a basket, and whatever that saying is, it holds true. Get a little bonus tip at the end of this one. Also, don't over diversify, because then you're just like everybody else. Weigh the risk rewards and you'll be fine. Speaking of wealth building strategies, I want to talk to you about MASTERWORKS.io, a place where you can invest just like the rich do without needing millionaire status. Now look, in today's day, we are experiencing a lot of craziness, right? High inflation, poor economic policies, war, oil prices and gas prices. I mean, it's crazy. To fight against this, one of the best things that you can do is to make investments that have continuously outperformed the market in an uncorrelated way. Now, you want uncorrelated assets so you can hedge against the crazy economic factors that we are facing, yet at the same time outperform the benchmark. Investing with Masterworks lets you do just that. Art has historically performed very well during extreme market conditions, much like we are facing right now. In fact, according to research, blue chip art has outpaced the S&P 500 by 180% from 2000 to 2018, which is crazy. One of the factors that makes art so valuable is the rarity, right? It's not like I can go and call my old friend Picasso and commission him to make me a painting. Even if you were alive, that'll probably cost millions and millions of dollars. But with Masterworks, you can very easily invest in multi-million-dollar art by buying shares in them. Masterworks also has a secondary market where you can sell your shares further if you want to, just like in the stock market. And when it comes to diversification, putting some of your wealth into art has proven to be a very smart move. Skip the waitlist right now by using the link down in the description to start investing with Masterworks today. Here is a mistake that is hard to fix because it goes against every instinct that you would have, really. But in the long term, it does more harm than it does good, and that is getting emotional about a stock that you lost money in and waiting for it to recover. Now, you might be saying to yourself, hey Alex, but why should I take a loss on a stock? Well, I'm not saying that. All I'm saying is that if you are holding a stock and continuously dollar cost averaging into a position over many years and that stock just keeps going down, then maybe it is time to reevaluate this investment and move on. The time wasted and money lost is not worth it when you can move on into a new and better investment. The smart thing to do is to have a stop loss on shorter term investments and cut your losses at a certain percentage and then just move on. For longer term investments, the same really should apply. You have a stop loss on, or even if it's a mental stop loss, of whatever percentage that you're comfortable losing. If the stock goes down 20%, let's say over the span of 2 years, well then it's obviously trending down and there has to be a reason for this. Now the question, how much lower can it go, is a very dangerous question. You begin trying to justify its potential recovery and only looking for reasons that this stock will recover rather than looking for reasons of why it went down and can potentially continue to go down. So my advice would be to have a mental note at the very least of when you should bail on an investment and stick to that plan. There will always be another opportunity and you could always get back into the stock if it ends up turning around. But instead of continuously taking these risks and taking these losses, just move on. Because the majority of the time that stock will either not recover or it'll take a really long time and the opportunity cost is just not worth it. Mistake number 8, trying to time the market. This one is an easy one, right? Stop trying to time the market and there you go. You fixed your problem. Stop trying to pick tops, stop trying to pick bottoms, it never works. Look, the best thing that you can do if you want to be a successful investor is to stick with what works. For the majority of people, the best thing would be to buy into a broad index fund and continue to do so no matter what happens in the market, which makes trying to time the market obsolete. That average market return that we talked about of 10% per year will compound, and I think you'll be very happy in 20 years' time. The next step above that would be to try to build your own portfolio because you like the process and you enjoy investing and valuing companies. And when investing this way, you want to buy the companies that are at a good price and a good value relative to what they are trading for. This does not include timing the market either. Lastly, when you are trying to trade and make money off of the swings of the market, it's always better to go off of the trend of the market and realizing that good trades take time to play out. So if there is an uptrend in the market, you want to ride that wave up and take profits along the way. If the trend reverses, then wait for confirmation that you are now indeed in a downtrend and then take advantage of that. But trying to pick the top and bottom of market moves never turns out the way we expect it. So we shouldn't do it. All right, here we go with the bonus mistake. Now, this is not really a mistake, but rather something that I didn't know for the longest time. And this is to complement your investments by using options. Now, options shouldn't be something that you solely focus on, but it is a very powerful tool that we have at our disposal that we can use together with investing in the overall stock market. We can build our portfolio and then generate passive income by selling covered calls, for example. We can use options to either enter or exit our stock positions. We can use in-the-money leaps to lower our cost of owning 100 shares of the company, but still be exposed to the same risk as owning that long stock position. There are a lot of things that you can use to get a bit of an advantage over the average investor. And that all comes down to learning as much as you can and then educating yourself about all aspects of investing. You can never go wrong with knowledge. Question of the day for you out there. Is there a mistake that you have made that wasn't on the list? Comment down below because this is how we can learn from each other. You know, it's funny, I was always told things when I was younger, and not just about investing, but about life in general. The mistakes and lessons learned by others. And what happened? I didn't listen the majority of the time, and I made those same mistakes. It was only after I made them personally did I learn from them. So even though this video was my attempt to give you a bit of a warning, at the very least, I think it is important for you not to just listen to me, but to learn through making your own mistakes. Don't be afraid of them. Now, maybe you won't make some of these particular mistakes. Maybe you will make other ones. And like I said at the start of this video, this is how we learn, we grow, and we become more successful. I hope that you enjoyed this video. Don't forget to check out my stock and option portfolio tracker with the link down below. It's my private Patreon group, and I think you might find some value there. Go ahead, share this video with somebody who you think might like it. Thank you so much for watching, and check out my other videos on investing. You can click here and here. Thank you so much for watching, and we will see you on the next video. Pandrea out.